you really got to work out what you want to do. So do you want to buy and post on the gram? Are you buying to make money? Are you buying as a home because you want to live in it?
And we're live.
Mr. Trainer.
Welcome to the podcast.
Thank you for having me.
So for those of you who are tuning in this week, I'm sitting here with my now brother-in-law.
Yes.
Who last week, was it last week? Lockdowns.
Yeah, it was, I think. 2 weeks ago.
Pop the question. So we're officially brother-in-laws.
That's it.
Which is exciting. But the reason that we have PJ Paul here today is that he is a property expert. You know, he's worked in property for over 10 years now. And with where we're trying to take this podcast is providing potentially life-changing conversations and making it accessible to absolutely anyone. A big part of that is purchasing your own home. Before we dive into that, though, I'll let you give yourself an introduction and tell everyone a little bit about who you are and what you do.
Definitely. Well, Kyle, firstly, thanks for having us on the program. I'm a long-time listener, first-time caller. I've been in real estate for over 10 years. My father was in real estate. My grandfather was in real estate. My grandfather's father was in real estate. I got into it being in sales, and then moving into selling real estate, I guess it was probably in the blood. Initially selling residential properties in metropolitan Melbourne, moving into industrial, and now selling hotels, office buildings, industrial property, retail, petrol stations, childcare centres, advising clients on all acquisitions and disposals, and we also manage property as well. So that's a little bit about me.
So you've actually... I think like a big part of what we talk about on the podcast is business as well. And you recently, well, not recently, but 2 years now? Yeah,
Jones Real Estate started in early 2019 or mid 2019. Before that, I had a business with a partner, and for a few years, but then started Jones Real Estate 2019. And yeah, time flies, 2.5 years, and get to sit here next to you.
That would have been a big move though, right? Like, in terms of you'd obviously worked your way up the ranks in, working for other people, and then you went into a partnership, and then to actually go out on your own, it's quite a big move.
I appreciate your comments. In any job, you got to do your time. You got to do the hard work. You got to do your apprenticeship, whether it's in a trade, whether it's in sales, whether it's in professional services or whatnot. You need to learn and spend the time doing the basic jobs and getting an understanding. I thought at the time, I'm 30 now, as of a couple of weeks ago. I was 27, 28 when I started the business, and thought, well, from a capacity perspective, I don't have children. I have a partner, long-term partner, but it was either take the opportunity then or continue working for somebody else. And I thought there's more risk in not having a crack myself than having a crack and failing. So yeah.
It's funny. So we've engaged an artist to do this mural up there, and it's your man. He's going up there, Harvey.
Ah, yes.
But he has a quote, and he goes, "That's the difference between me and you. You play to lose small, I play to win big." And I think that, there's a reason I kind of talked about that and wanted to bring that up, because we're obviously going to talk about first homeowners and these kind of things, but I think the reason that you're in a position to have this conversation, one, because you're experienced, but you also have assumed risk and got skin in the game as a business owner as well, which I think goes a long way. And although you'll play it down, I think starting your own business and going out on your own is such a big move for anybody, no matter what business you're in, because you do assume so much more risk. But it's interesting about the risk profile, right? Like the age comes into it, the situation, and so on.
Yeah, well, risk versus reward. we'll probably touch on it later in the conversation with buying and selling and investing. As you know, the bigger the risk, sometimes the bigger the reward. And I weighed up the opportunities and thought, this is something that I want to do, and I want to go out and have a crack. And failure is not an option, but you yourself, you've also taken the risk as a young guy, and hats off to you as well.
Yeah, I think, but that's the mindset, right? Like, for me, it's the same thing. It's like, I don't have kids. I'm young. I've got an opportunity to go out there, and it's one of those things that for me, I don't want to look back and say that I didn't. Like, I'd rather go there and have a crack rather than kind of go through life, or at least get to the end of my life and say, oh, I regret not actually going for it or having a crack at it. And I think that's important for people to hear. Most importantly is
and I ask you, that's more of a risk, going through your life and not having a crack and not being happy, and being a 90-year-old man one day and just sitting there saying, I should have done it. So that weighed up on me personally when I was thinking about it, and as was said now a couple of times, the risk, it was more of a risk not doing it. So
it's good insight into the mindset. I think a lot of people struggle to maybe take that step at some point, and obviously it's different depending on where you're at in your life as well. But yeah, I just thought I'd bring that up because I think it's. You don't give yourself enough credit for those kind of things, but I think there's a lot of insight that can come from something like that. If you're younger, who most of the people listening to are younger, they're either thinking about getting into business, or they've got the future aspiration to, or they're already in business, and they're also looking to invest their money, which is kind of leads us to where we're at now.
Yeah,
buying your first home. It's funny because we talk a little bit about investing on this podcast. We don't talk about property investing, but someone hit me up on Instagram and asked me a question and say, hey, what do you think about the property market and so on? And I go, it's not my wheelhouse. I can't give you any advice there because it's not something that I'm an expert in or have experience in. But then I put up a poll and said, is this something that you all want to hear? And we got quite a few. So then I called in you, the big fella, brought him in. And I think a good place to start is, what is the process of purchasing your own home?
Yes, good question, obviously. And I guess before I answer that in isolation, I think, and you mentioned young people are the main listeners of the program, a life, and we touched on this a while ago. As you know, Danny is pregnant, my partner, who's my fiance now, as of a couple of weeks ago.
Yeah.
She, she's about 28, 29 weeks. And you get to 12 weeks, and that's when you can announce it into the public, according to the professionals. Some people go beforehand, some people go afterwards, but at 12 weeks you're pretty safe to announce it to the people. And often you see on Instagram people doing a photo and you're with X-ray and getting excited, which I think is awesome, by the way. But we elected not to do that, and I did tell a selection of my friends this in a text message, etc. But I'm a relatively private person in that regard. And it wasn't until about 20 weeks when I had a call from a really good mate, and he sort of said, well, Paul, are you going to announce that Danny's pregnant and you're expecting a child? And I was like, oh, no, I wasn't really planning on it. We're really, really pumped up and excited, but I don't really feel the need to do the post. And he sort of said, yeah, I understand, but people obviously don't know about it, or sort of know about it, or hear about it from whispers, and people are starting to think that could there be something wrong, or, maybe you don't want to talk about it as such. And then it just sort of hit me, and relaying this back onto the property, buying property, we chose not to post it on Instagram. When people do, that's awesome, and I think it's a really good thing to do, but we elected not to, and people were sort of judging because we didn't do it, which made me think, young people buying their first home, a lot of the mentality in buying a first home, and that's the crucial part to it, is they want to put it on the gram and say, how good am I bought a property, which is an awesome achievement, don't get me wrong. But the mentality for buying, I think, you really got to work out what you want to do. So do you want to buy and post on the gram? Are you buying to make money? Are you buying as a home because you want to live in it? And the 3 or 4 or a number of different factors ultimately weigh up to what you're wanting to get out of the outcome.
It's so interesting. You see the same thing on the other side of investing as well with stocks and so on. Like people, there's actually there's this guy, right? And he lives in Singapore. I don't know who he is, but basically what it is it's a crypto group, right? So it's a crypto group. Everybody's in it, and he kind of gives you these tips, right? So, I actually think this could be fucking illegal, right? But what he does is it's like, it's actually leverage trading. So I don't know if you know what that is, but it's like, so I could put a trade in that Tesla will go up, right? Now, if I've leveraged that, it means that let's say it goes up 5% and it's leveraged 5x, you'll get a 25% return. But it also will be you could go 25% negative, right? So if I put $1,000 in, I could go up 250 from that 5% increase, or it could go down 250.
Yeah.
Right? But what he does is like, he gets all of his kind of crew or whatever they are to post on Instagram. And it'll be like a 252% return, right? Because they're leveraged like 20x, right? So, and then it's tag him, and it's all these kind of things. And then, I've seen quite a few people pop up now, and they're like tagging, and it's like this 250% return, right? And there's two sides to that. It's an ego play. It's like, I want people to see that I made 252%. You've probably got $50 on the line, right? You might have put $500. You might have put whatever, right? But that's the first side. So it's the ego of doing it. But then it's also the, if you're, let someone who is not invested in stocks, you're not invested in property, you're not really invested at all, and you see a 252% return, what are you going to do? You're going to say, I want some of that 252% return.
Definitely.
Right, so I think it's a similar kind of situation, right? Where it's like someone's either posting it for the wrong reason. They're like wanting to post a photo of buying a home instead of either enjoying the home for what you bought it for, or looking to obviously make a return or make some money.
Yeah, so 100%. And I think if you're going to buy a home, you need to work out what your reasons are behind it. And I think the people who I've seen make the most money or the most satisfied with their purchase, they leave their ego at home. So when people ask me about, I'm looking to buy my first home, I'm looking to do this, I generally ask them 2 questions to understand what they want. Why are you buying? Is it for a property to live in? Or is it for a purely investment on a secondary way in order to make money? And I generally give advice accordingly. Now, the answer is generally both, but after further conversations with each person, we generally narrow down to what they want to do, and ultimately their sacrifices need to be made. I.e., I want to live in inner city Melbourne, and I want to buy a house, and I only want to pay $600,000. Okay, that's great. Well, the reality is that you're not going to be able to do that. Yeah. And they also want to see 10% growth every year for 3 or 4 years or 5 years, and then do whatever they want to do. So, you're buying in for lifestyle, to live in this property for a home and live there and sacrifice potentially some capital growth in some areas, or are you prepared to sacrifice your lifestyle, buy out in maybe a growth area or an undervalued location, and use the property as a stepping stone to build some equity, sell the property, or use it as down the track, and then use that as a leapfrog to be able to buy the property that you want in the area that you want to move into and live in the medium term.
Let's explore the second option for a second, just so that people can understand of how do you actually make money in property. Like, if somebody's looking to build personal wealth, how do they actually do that?
Well, say you buy a property for $1 million for our numbers' sake. and it goes up at 5% a year, there's 50 grand a year in capital gain that you get. If you're living there as your principal place of residence, you're making that 50 grand or that 5% tax-free, assuming that you live in it for the entirety of and as your PPR, principal place of residence, for the entirety of your ownership. So over 5 years, if you're making 50 grand a year, that's $250,000 gain, tax-free. At the end, if you sell it for $1.25 million. You have to factor in some land tax. Well, you wouldn't because it's your principal place of residence, but council rates, agents' fees, selling and legals, etc., which would come out of the gain. But ultimately, on the basis of pure purchase price, $1 million to 1.25, 5% a year, there's a bit of a gain. Whilst you're also paying off a loan. If you've got a loan repayment at the moment of 2%, some of the big banks are offering, people are doing sharper. You'll also be paying down that loan over a period of time as well.
And so it's almost like you're making money two ways, right? So you're making money in obviously the capital growth, and also it's almost like savings in a sense, right?
Yeah.
So instead of paying rent, you're paying down a loan, which once you sell, it will equate to an amount of profit.
Correct. Yeah, you do pay a bit of interest at the moment. Interest is marginal. If you look at inflation's higher than some of the interest people are getting. What's inflation at the moment?
Well, there's two metrics. So there's the CPI.
Yep.
But then there's also the rate of money that's being printed. So don't ask me because
I've seen
a rabbit hole.
Yeah, exactly. You're pretty vocal on the topic.
Yeah.
But yeah, okay. So the interest you're paying at the moment, it's marginal in comparison to inflation. So you're sort of borrowing. In some people, you're borrowing money for free. But that's one area. Another could be an area where you invest. You buy an apartment. You pay $1 million for the apartment. It'd be a pretty good one. And you lease the property out to tenants, and the tenants pay you an income. If they're paying you, 50 grand a year, you're getting a 5% yield on the return. So you'd be paying down your loan. You could be covering the 2% interest. You could be getting a bit of surplus. You'll need to factor in land tax because it's not your principal place of residence. You need to factor in if it's an apartment building, you'll have owners corporation fees, council rates, statutory outgoings, etc., that come off the rental income. But you could be getting a cash flow surplus there, depending on what your loan is, and then. After a period of time, if you were to look to sell that, if you made a gain, you've got your gain from your rental income, and you got your gain for the capital growth appreciation over a period of time as well.
Mm-hmm. Okay, and then the final option is obviously just a home that becomes your family home.
Yeah, so that's like the first scenario. You could buy a property. You could, as a lifestyle, you want to build a family there, you want to live there for the medium term, it's in an area that you want to live in, and you're owner occupied, and it might go up if you've bought it at a good price or in a location which has got growth. It might not, but you're not worried about that because you're looking at it as purely as a home and not a money-making exercise. So that's down to the lifestyle.
Yeah. So then we look at what are some of the common mistakes? I mean, obviously there's the mistake of not knowing why you're buying, but I guess furthermore, what are some of the most common mistakes that you see first home owners making?
Obviously ego plays a really big role. People buying for Instagram and to promote that they've bought a property. The Australian dream is you go out and buy real estate and you become an owner, and it's a bit more glorified than what it actually is, in my opinion. But it's still a very good achievement. But a lot of people aren't prepared to spend the time, researching, working out what they want. They just want to seek the reward and want to, miss all the steps and just rush in and buy straight away. They want more than they're prepared to wait and spend the time accordingly. Probably you'll see it in investing, right? Tesla's all this hype or Bitcoin or whatnot, and they just want to get in, say they've got in. So they're not prepared to do the due diligence and research, which can ultimately really come at a major cost.
Yeah, I think it's definitely something you see in investing. It's something you learn as well. I'd be lying if I said I didn't make those mistakes in investing. I think the difference is that when you're investing in a stock, one, it's liquid, and you're not investing the substantial amount of money that you would be in property. but it's interesting the fact that mistake doesn't, people aren't taking it more seriously. And it's very easy to do, like people are busy, like that's the reality. But I think even like myself and Liv, obviously we're looking to get in the market. We because we're busy, we were probably making those mistakes early on too. We're like, Ascot Vale, good area, like it's a growth area. But like, do we actually know that it's a growth area? Have we actually looked at the numbers? Have we actually, or are we just going off what somebody has said, and speculated?
Well, everyone's an expert. Everyone's an armchair expert. I mean, Olympics on at the moment. How many people are sitting back on the couch saying, "Oh, you should have done that. I would have made that putt in golf. I would have, you should have ran a little bit quicker and beat the guy on the line." So everyone's an armchair expert, and everyone's, for a good reasons, likes to give their opinion. If I'm getting advice on a matter, if it's stocks, I come to someone like you that I know that knows a lot more about it than I do. And if I'm getting advice on property, and by the way, when I'm looking at real estate, I'll go and speak to people to get their opinion and advice as well. So people that I trust, and I'll take their word, and weigh it up with options, and you got to go to the right people, so to speak. In my opinion, at least. Yeah,
you do. You have to have the circle around you, 110%. Like, it's interesting. Like, I've got people around me, and you'll speak to them on a matter, and it's like someone you might look up to, right? And they might be doing the same thing as you. So the example is like there might be somebody that you look up to who's buying a property, and that halo effect comes in. Like they're not a property expert, but they're buying a property, and you look up to them, and you can kind of get sucked into being like, okay, well, that person's doing this, they're successful, and I'll go and listen to them and take advice from them on that. And it's interesting because that happens to myself. Like there's people out there I look up to from a business standpoint, but from an investing standpoint, I just there's like a breakdown there. I don't think that they're as skilled. But and this is where like critical thinking comes in, doing your own research, the ability to even, and I guess the comparison I make is if you're in let's say it's a group of friends, right? And you're sitting around a table, and 4 of them say that Ascot Vale is a great place to buy, but those 4 people don't necessarily have any experience. None of them have bought properties before. They haven't done their research. They haven't looked at the numbers. They haven't looked at the analytics around it, and done their own research. But because the majority's there, or our friends say it, or we hear it from a particular person, maybe one of them's a great businessman, and has grown a really great business, and they're now looking into property. But I think it's you can fall into that mistake, right, in any type of investing. And that's what I was saying before, like skin in the game is so important. Like, I learnt that lesson. My old housemate, Jordan, he sent me a stock. He goes, it's a tip, a few of the boys from the doggies have got on it, and like it's a good thing. And
hopefully not a sporting tip.
No, not a sporting tip. It was a stock tip. But we got into it, and I put money into it, and it went down about 70% within 2 weeks. And I feel like that's kind of what I mean. I think if you're going to buy your first home, I'm lucky, that was not much money, and I only learnt that lesson once I actually put the money in. Whereas, I feel like it's going to be a lot more harsh if you're doing that in property, because you're putting down, 10% minimum, 12% of...
and guaranteeing the loan as well. I mean, property's up there with one of the people's, the most expensive purchase they'll make in their lifetime.
Yeah.
But going on the advice section, fortunately I get to deal with some really how do I say it, successful is probably the right word, business guys, property developers, property investors, and I look at them in awe, saying, this guy's, I'd love to be like you one day. And they're not talking to other people seeking advice. There's a guy that I previously worked with and for, who's a very successful property developer and investor. He would walk around the office and ask people their questions about a property that he'd be looking to buy, always asking people for their opinions. Mm-hmm. So you can never not ask, depending on what level you get to. So So that's one thing that I certainly learned. Never stop learning.
Oh, 100%. That's what I love about, that's why I'm so into stocks. Like, it, one, teaches me a lot about business. Two, the research is the one thing I actually do love doing. It's one thing I do every day. I sit down for an hour and I just read through articles and I look for potential opportunities and these kind of things. But I think you learn a lot from those. It didn't start the way it is now. That's for sure. My first year in investing, I think I had like more losers than I did winners. But now, it's doing better.
That's good. That's good. But in terms of property, you're researching, realestate.com or the REA Group, I personally think they're quite a good platform. They've got suburb profiles on different areas. So if I'm looking to invest in a suburb, I will jump on realestate.com. It gives you 5-year averages, capital growth for houses, for units, median house prices for the area to sort of give you an understanding of the underlying land value, and then how they've performed over a 5-year annual basis.
We'll come back to that because that's going to be one of the topics that I want to cover pretty comprehensively. The next, I guess one of the things is the process, right? So obviously, are you able to give people, I guess, a walk through the step-by-step process of buying your first home from, the very beginning of starting and saving and, like if you're looking to spend X, you need to have this kind of money saved and then, obviously going through the loan process and then looking for the property? Yeah,
definitely. So initially, it's probably working out your budget and your borrowing capacity and assessing that with your lifestyle, i.e. you might be able to afford X, but it would hamper your lifestyle and put you under a significant amount of stress. You don't want to spend that much money, or depending on the situation. So one, understanding your budget. Now, there's many tools online, whether you want to go on ANZ or CBA or Westpac, they've all got borrowing capacity, borrowing power calculators online that can give you a bit of an indication. I would suggest before you're going and looking and putting an offer in on a property, to speak to a lender, whether it be a mortgage broker, whether it be the major banks themselves, if you've got some experience in dealing with them. If you're a first time, I'd suggest mortgage brokers generally add a significant amount of value. I use mortgage brokers. I deal with some of the banks as well myself, but I find mortgage brokers generally get the best outcome for the client. I'll drop Entourage Finance. There's a guy in there called Vincent Moore who's very good to deal with, so I'll shoot you his details.
We've been using him.
Yeah, he's very good. Well, we have used him, me and Danny and I, so they're good. But so understanding your borrowing capacity, working out what you want to spend, and then the implications that has on your lifestyle, and then going, okay, well, I've got $1 million to spend, $500,000 to spend. Let's go out and start having a look at the market. So before you go out and start looking, you need to make the big decision. Am I buying as a property, as a lifestyle, as a home? I don't really care as much about the long-term growth. Yes, I do want to buy something that goes from value, but it's a lifestyle decision. Or are you looking at buying something where you want as a purely as an investment? You might live in there to save on the principal place of residence gains, tax gains, etc., capital gains, or you might want to rent it out. But you're looking to buy something cheap, undervalued, that you think will grow. In my opinion, if you're a young investor and you're looking to exit in the medium term, less than 10 years or less than 7 years, my suggestion is capital growth is very useful as a young investor, because you've got a good working life ahead of you where you can pay down debt. So, you need to work out which one you want to do. You go out and speak to real estate agents, speak to a property consultant. If you want to come and speak to me, I'm happy to give advice. I always give advice, sort of understand what you're wanting to do. And then, you go out, spend time looking it open for inspections, cross-checking statistics, speaking to someone who's acting on your behalf. Speaking to buyers advocates is often a good idea, who act for the buyer, where you've got real estate agents whose job is to act for the seller, unless you've got someone who is acting with your interests at heart, which often real estate agents do. We do it all the time. And then, exploring the market and the opportunities. So understanding your capacity, putting that against your current working and household lifestyle, and then assessing what sort of property you want to go after.
What are some of those working and lifestyle considerations, right? So, because that, for somebody who doesn't know any different, like they've lived their life, their entirety of their life, well, you'd hope so. But, it's kind of like, what are some of those considerations, right? Because, I would assume that you don't want to spend too much that you kind of hamper yourself, especially if, you've got a fixed income and so on. So what are some of those considerations?
Well, from a lifestyle perspective, I mean, you buy a property, you're going to have to be paying a monthly mortgage repayment. You're going to have to consider statutory outgoings, council rates, water rates, etc. Owners corporations if you're in a multi-tenant, strata titled building, and then you've got your other outside factors. You're young person that wants to go out to the nightclubs on the weekend, create an allowance, create a savings allowance on top of that. You might want to go on holidays throughout the year. The best thing that I ever did, and I did it too late, is I put together a cash flow from the 1st of January to the 31st of December and put all my expenses there and just thought which ones come out every single month, put different rows and columns, and just sort of wrote, okay, well, I've got X amount of money that's coming in. These are my overheads, which I will need to attribute to. And then, okay, well, I can't not save. So put it in a portion of savings. I want to spend money on clothes. I personally don't spend too much money on clothes, as you can probably see.
Don't worry, mate, I'm the same.
But, an allowance for holidays, Christmas presents, birthdays, friends, occasions, just plug them all in there. And then you can work out, okay, for this month, this is the budget that I've got to be able to spend. This is the lifestyle that I want to lead. That enables me to attribute X amount towards a home loan, and without heavily impacting my lifestyle. Some people might go, all right, I'm going to give up on the smashed avo on the weekend, all the coffees every day, but I need my gym membership, but I won't go on holiday for the next 2 years, and they work it out, whatever suits themselves. So,
yeah, 100%.
So cash flow is very important to understand, and I don't think enough people do it.
We had a conversation the other week and kind of picked apart. We had these cash flow. They've got a company called the Cash Flow Dojo, and basically what they do is they help people learn about cash flow. But it's interesting. We kind of had the conversation about the barefoot investor, and kind of looked at and just had a discussion about it. But I think it does bring up a good point. Is that our biggest thing was like people don't understand it, and they look to the barefoot investor as their kind of gospel around it, which I think comes from a lack of education. Like, I don't know, like, did you learn this stuff at school? Is this something that they focus on?
No, I didn't. My parents used to tell me about saving, etc. But when I first got in the workforce, I was getting, X amount per week. And that's how I'm like, okay, well, that's how much money I got to spend this week.
Yeah.
You get to the end of the week and you've got nothing. And I did that all the way through, up until I was probably in my middle 20s, even pushing into it. So that's something you don't learn. But I think the people that are listening to this program, they're obviously interested in investing, and I love going to my cash flow and working out how I could do a bit of saving here, what I could do. It's a really enjoyable exercise.
It's a relationship thing though, right? Yeah. So it's enjoyable because you've kind of gotten over that hurdle. I mean, I'm the same. I reckon maybe until I was 25 or 24, probably 24, I reckon, just turned, or 23, did I actually really start to sit down with my cash flow every week and go, this is, and start putting money away for certain things, start investing money, start looking at how much I can invest and kind of putting money in different places. But to do that, that's the hardest thing, to take that first step where you sit down with your cash flow every week. Because a lot of people, it's a lot easier, and I know this is what I did. It's like, same thing, I've got this much to spend, but it's almost like, because I didn't have to deal with it then, you know what I mean? And for me, it's like, my mum never taught me about cash flow, like never. And my dad definitely didn't either early on. So for me, it was like, I read a book called Profit First when I was 21, 22. And that made it a little bit simpler, and that was like a foot in the door. But if I had never have read that book, I probably would maybe something would have come along the way, but I would never have learnt about cash flow, and I would have still been in the same kind of circumstance there where I was just had money coming in and money going out.
Have you read The Richest Man in Babylon?
No, I haven't, but apparently it's amazing.
Yeah, it's good. The long and short initially is you get paid, you pay yourself first, and then you pay your bills afterwards. But that's something that I read after researching or whatnot, and it's a tough book to read. I mean, the old school English language is a little bit difficult, but there's some pretty good principles in there which I learn a lot from. Also, dating our partners are sisters. They're quite good savers, so I have to give a lot of credit to Paul, Danny's father, and Annie as well.
Was there periods of time when you would have conversations about how much money they had saved, and you just go, beautiful?
Yeah, they'd say, "Oh, I'm broke." I'm like, you look at your savings account. It's more than mine. What do you mean you're broke?
That's the whole notion of putting all the money away and then being broke. Which
definitely.
I was definitely the opposite for my younger years.
Oh, well, you learnt now, so it's good.
All right, so let's talk about growth now. So we've gone into a little bit about the process, and you got to save your money. You got to make sure you've got the money there. Then you go and look at your borrowing capacity, and then you're ready to buy. What are some of the considerations or the things that somebody should look for if they're looking for that capital growth, if they're looking to make some money out of property?
So I guess in terms of work out what your budget is, and then plug in that amount. And if you use realestate.com.au, you type in Victoria, and then you can sort of assess what you can afford to pay in certain areas. You might click apartments, you might click townhouses, houses, etc. And then you look at different suburbs that you like. Personally, I looked at different areas when I've bought properties in the past, and I'll go. The fundamentals of real estate are very important. Location. You hear it all the time. Proximity to public transport, retail, strips, shopping, essential services, Woolworths, Coles, Aldi, supermarkets, etc. You got to. I spent half my life in these things, getting stuff all the time. Markets, sporting fields, parkland, and then public transport and freeway logistics. So are all important. Assets to make a good location, in my opinion, primary schools and schooling education, etc. So I would look at areas that I think that had the fundamentals from a location perspective, and then compared them on selling prices of properties. So you might look at suburb A and suburb B. You might prefer suburb A, but suburb B still has the fundamentals, and then go, okay, well, the median price or for the money that I want to spend in suburb A, I can get 30% cheaper in suburb B, but I only think it's a 10% better suburb, and my opinion, it just needs a couple more trendy cafes or shops and whatnot, and then it's sort of getting better logistically. It's probably closer into my lifestyle or areas of employment and other factors. I think that I might prefer to live in this suburb, but suburb B, in my opinion, is significantly cheaper, and I, for that reason, think it's undervalued. So that's what I'd personally do. So we went out and looked at and real estate, and we sort of said, these are the sort of suburbs for the price that I want to spend, and we rated them all. I checked REA Group for the median house prices, got an understanding of the land value, compared them all in terms of their retail strips, proximity to everything else, as I've just touched on, and made a call. So that's a good way to spot value in certain areas, etc. So, that's, if you're looking for capital gain, you could go, okay, in 5 years' time, a bit of infrastructure, a bit of appreciation in values. I think there's probably more potential in this suburb to increase, whereas suburb A is a little bit nicer now, but the improvement probably isn't there to make it better other than just demand. So, that's when you can do really well out of capital growth.
It's interesting. So and when you're comparing suburbs, because obviously there's like, maybe I'm wrong, but there's like internal to a suburb, right? So there's like you said, there's like park location, essential services, and so on, and all these kind of factors that you factor into the suburb itself. Because I mean, I may be making an assumption, but I would assume that all suburbs have those things.
All suburbs have got different features. So yes, some have better than others.
Okay, and that's what you're looking for.
I'm looking at, it depends. It's one on the price point, and then on if I'm buying for capital growth, I will look at areas that have got the fundamentals, compare them to adjoining areas and then check prices out, and then slowly you can work out this one's 20% cheaper than this area. I think it's got a fair bit of growth in it because this area is more expensive, therefore it's more affordable, and over a period of time I expect it to reach up accordingly because it has the same fundamentals in place. Okay.
So really you're looking like, you could do like a profile on some of these more well-known suburbs, look at, what makes them, what are the characteristics that actually make them successful or,
and then compare that price point into other areas such as well.
Yeah. And then that allows you to try find a deal.
That's it. And as we've touched on recently, the best guys that are buying property that I've seen, they'll look at 100 properties, buy one. Always looking. These are the fundamentals that I want to buy. To me, this is what the price is. I'll give you an offer of X. Take it or leave it.
And this is where the ego comes in, right? Like me and Liv are looking at doing this as well. And for those of you who don't know, this is our second attempt at doing this. We had some technical difficulties in the first one, but after listening to what you said, went home, spoke to Liv. Let's start branching out other than the suburb we were looking at, and it definitely makes sense because it opens your horizons and you start to look at suburbs and go, okay, well, why is this suburb over here 20 to 30% less than this suburb over here, and your ego comes into it, right? Because you want one now, you always want something now, and you have a previous perception on certain suburbs, so and I think that's the hardest thing to overcome, right? Like there might be suburbs now that I know Liv, there's suburbs I mentioned, she's like, no, I'm not going to live there. You know what I mean? But it could be the right deal. And so it's interesting. These are the kind of cognitive biases that you can have when you're going to search or look for a good deal.
If you want a good deal, you got to take the ego hat and the emotional hat off and put it to one side, and then just look at it in just profit and loss and go, okay, this is what I'll pay, and that's capping it. And then you either get it, fantastic. You don't, you move on and start looking for the next one. So that's if you're solely buying for capital gain, and as a long, bit of investment.
And that's what the best do, right? So if we're talking somebody who's wealthy, we're talking somebody who's got a massive portfolio, who's built it up from nothing. They started at one just like everybody else, and they've kind of worked their way up. That's what they do. They look at deals.
That's it.
Awesome. All right, so we're going to go into a brand new segment that we've got on the podcast. So you're testing it out from the first for first off, and basically what we're doing in this segment is we're going to ask you some questions, and you've got basically it's just 1 minute, right? So 1 minute, and to either give some advice on it or tell us what you think about it, and then from there. We just start working through these questions. And the whole idea is we just want it to be really simple, and kind of some simple advice that's straight to the point for the listeners at home.
Sounds good. Is it about Bitcoin?
It's not about Bitcoin.
Okay.
I was actually going to put one in. I was actually thinking about it. All right, so number one piece of advice that you would give yourself 5 years ago.
One piece of advice I'd give myself 5 years ago. I reckon it would be cash flow, because setting up a cash flow and then creating goals from it. I think since I've been implementing that myself, which would be 5 or so years ago now, it's just enabled me to plan for the future a little bit more and work out what's realistic, what's unachievable, what do I need to do to get my goals. And I think that combined with goal setting, as it sort of makes you more accountable. That's definitely something very important, I believe, which they don't teach you at school.
Yeah, I often think, and it's probably not a great mindset, but it's like, you know, where would I be now if I knew what I knew now at the age of 18, you know, or at 19 or 20. And if I had the cash flow coming in and I knew how to invest and get my money to compound, you know, like where would I be? It's definitely something that goes through my head as well. So that's something I would agree with.
Well, yeah, everyone's the managing director of their own business. You know, whether they work for somebody else, they've still got their things that they need to adhere to outside of, you know, in their lifestyle. So I think it's very important.
Yeah. Next question.
Biggest mistake first home buyers make? Ego, number one, without a doubt. Ego and emotions is the biggest mistake people make. And I've seen people make really good purchases on sheer luck. And I've seen many people lose a significant amount of money by not doing, you know, assessing things properly and letting their ego and emotions do the talking.
100%. All right. So this is an interesting one. How much is too much debt?
Good question. I've got a bit of debt at the moment, but I factor in low borrowing costs, interest costs, etc. at the moment, and I'm taking a risk or a bullish approach on certain areas that I'm investing in. It comes back to each person and their personal circumstances. So understanding, you know, what impacts their lifestyle. And as I said in the first point, if you have a cash flow, you will be able to make rational decisions that factor in every circumstance that you've got. So it's on a case-by-case basis. So
awesome.
I'm taking on a bit, but it's all considered and factored in.
Yeah, I mean, it's. I reckon that's one thing you learn as well. Like, I think it's something that you learn as time goes by. Debt can be seen in two different lights. You know, when you're younger and you don't know too much about it or how to leverage it, debt can be one of those things you're like you can see it in such a negative light. And then debt can also be seen as the quickest and fastest way to build wealth. And that's how many do it. You know, they leverage their money, knowing, and again, you know, being able to make those correct decisions, you know, because if you don't, it can burn you. That's definitely something that I reckon a shift in perception as you get, I know for me, it's as I get a little bit older, you know, I went through bad debt when I was younger. You know, I crashed a car at the age of 18, was about 40 grand in debt. And had to pay that back, and you know, it took me quite a few years. So for me, debt was one of those things that I avoided at all costs. And then you start to get older and you start to look at the ways that you can build wealth, and that definitely changes.
Understand. I agree.
All right, so lastly, we'll get you to give your business a bit of a plug. Jones RE, tell everyone where they can find you, where they should look for you if they want to learn a little bit more.
Definitely. Jones Real Estate. We're on all social media. We've got a website, www.jonesre.com.au, Instagram, Jones Real Estate Australia, I think it is. We have a Twitter account.
Twitter?
We're not on TikTok, but we're evolving. We'll be on there shortly, hopefully.
Twitter?
Yeah.
Is that big in the real?
It's 2021, Kyle.
Is that big in the real estate game?
Well, Elon Musk's on Twitter, so I think we're emulating him. So.
I reckon if you should go out like Elon, you should go rogue on your company and just start tweeting erratic, irrational tweets.
Could be an option. We'll assess it afterwards. But yes, and then otherwise on email, paul.jones@jonesre.com.au. Happy to field any questions that come through and give you my advice. And we've got a very good team. We've got Tim, Sam, Luke, Lauren, Charlotte, Jack. You know, we've got a very good team of property professionals and specialists that will go out of their way to give the right advice. So, yeah, feel free to hit us up.
Awesome. Well, I appreciate you coming on. Thanks for giving us or sharing your experience and your knowledge with everybody. Buying your first home is something that can be quite overwhelming at times, especially if you don't know what you're doing. Like a year ago, for me, it was like, as you said, you don't know if you don't have the knowledge there. It's hard to make those correct decisions as you talked about. But yeah, big thanks for coming on. And to everyone who tuned in, we really hope you enjoyed the episode. Remember to hit the subscribe button If you want to hear more episodes around investing, building wealth, building a business, and more so building character as well. Thanks for tuning in. We'll see you next week.
Thanks, Carl.